Howdy, Jacob here. Today I'm going to do a somewhat in-depth review on Capital Product Partners. This isn't as in-depth from a note standpoint as my previous in-depth videos have been, but I felt like I didn't need to capture as much here, and so because there's a lot of interesting things which we'll get to. So, first thing I want to say is that it's an Athens, Greece based business. So, keep that in mind if you don't buy companies outside the US or that are advisory shares. And if we look at their balance sheet, their most recent quarter balance sheet, they have 93 million in cash and cash equivalents and then 1.5 billion in long-term debt. And so, yes, the company makes earnings and free cash flow, if you remember, but they have very little cash on hand for if that were to go bad quickly. As we can see, three of the most recent 4 years essentially have been negative on the free cash flow side, which is not great, which is why to make this acquisition. And again, this looks weird because the company, when they report their free cash flow, they include acquisitions in the line of property, plant, and equipment. So their capital expenditures line actually does include acquisitions, which, if we look back at the free cash flow statement, is why the free cash flow has been so inconsistent. And that's because um, yeah, that's because the capital expenditures have acquisitions incorporated, and so there's big negatives after cash from operations. But even still, if you want to invest in this company, you have to realize that one, it's based out of Greece, and so you have advisory shares, and then two, this company has little cash on hand compared to their debt. 145 million, or in the most recent quarter is 95 and 1.2, and now they have 1.5 because for their capital expenditure or their acquisition, um, they used mostly debt to finance it. And so you look at this dividend, if you look outside of their debt situation, you will find that things look very attractive, as we can see a 12 million dividend payout. If you look at the last couple of years, they can definitely afford that. But you have to understand the company's balance sheet and why, and have to balance out whether that makes you comfortable or not. Because buying a company and looking at their balance sheet is similar to how would you want your own company or yourself even to run your own life? Would you only want, $10,000 in cash and $1 million in debt? And to me, wait, what would that be equivalent of? So 93 million, 16 times. So if I had $10,000, I guess it'd just be 160,000. Okay. I guess that if that were to include your mortgage and such, like, that could be fine. But you really have to think about it from the company's perspective and their free cash flow and earnings. What are they going to be in the future, and will they make up for those? What will be now due to the interest rates being as high as they are? Will that be fine for all of the interest expense that they will accrue on this massive $1.5 billion in debt that they have? And so I think it's less about the numbers. I'm going to finish off the numbers, and then I'm going to finish with what it would take to be comfortable buying this company. But for me, there's really only a couple of things I changed. So the first thing, share change, I just increased it a little bit. I looked at their income statement, and their shares increased a little bit more than the 1% that I would have assumed. And so I just put 2%. And then the terminal P changed a lot. And so what I did was I um, looked at their historical PE and price to free cash flow on a yearly basis on macro trends and their price ratios. And so as we can see here, the only times they're over 10 on the PE side is likely when they have very little earnings. If we were to go back to 6/30 2018, you'd see that their earnings were just very small. And so if you look at like a more normal year of earnings, we're looking at 5, 2, 2, 2, 1, 2, 3, 3, 5, 4, 5, 3, 5. And then over here, even same thing. And then on the free cash flow side, where they've been pretty volatile, but you can still see their ratio has consistently been fairly low, not in line with the um, 13p that you would usually give a company that, or roughly 13p that you give a company that has 3% growth for the next couple of years and then likely has similar growth afterward. I think people are taking into consideration that one, it's a foreign company, and then two, their debt situation is a bit scary. And so I incorporated that historical component of PE and price free cash flow into my current assumptions. And then I actually increased the discount rate due to the company's debt situation and how I do not like it. And so um, the numbers point out that the shares would have to fall 41% to give you a 17.5% rate of return, which again sounds very great. But there are companies. So I personally think like every company has a price, right? But to me, I would have to buy this at levels that were dumbfoundingly cheap due to the fact that their debt is as high as it is, their cash on hand is as low as it is, and the fact that there's so many other companies out there that I'd feel more confident in owning. It just seems troublesome for me to go out of my way to keep researching and keep looking at why this company fits my standards when it might just not. And so I already feel like my scope of businesses is greater than most because I view companies on a like if I can understand the past and where they got those numbers from, it's easier to forecast future. Whereas Warren Buffett and uh, Pabrai always say, keep within your circle of competence. My circle of competence, I feel like, is just calculating cash flow. I'm very comfortable in modeling, and so if I feel comfortable that the number how they got the earnings, revenue, free cash flow in the past, I'm able to forecast that into the future based on the past and look at the acquisitions they made, how that could influence the business, whatever. But there's going to be companies that I'm limited by in the fact of like I don't understand what the management was thinking to go into this much debt and have such little cash reserves on hand. And so to me, I mean, I likely wouldn't be buying if it fell 40%. I'd still be I'd be contemplating whether I'd want to do more research on it or just say I'm going to relax, I'm going to look at all the other 10,000 companies out there, and maybe 5,000 of them make a lot of more sense to me. I'm not going to waste my time looking more into something that I just have trouble understanding. So hopefully that was just a quick. Hopefully that wasn't too long of a rant about um, trying to truly understand a business, and if you can't, don't force it. So thank you, and have a good rest of your day.